There is a specific type of silence on Wall Street that occurs right before a floor collapses. It's the silence that happens when the narrative, the story that everyone is sold on, finally runs out of breath, and the cold hard numbers actually take over. Just 24 hours ago, that silence was shattered by a Q3 earnings report that was nothing short of a catastrophe. We're currently living through a massive technological gold rush. The AI revolution is real. It is minting millionaires and transforming the global economy. But in every gold rush, there are those who mine the gold, those who simply sell the shovel, and then there's a third group, those who put gold mine on everything they do just to capture the hype. I recently took a look at C3 AI, ticker symbol AI. If you own this stock because you think it is a pure play on the future of artificial intelligence, I have some news that you are probably not going to like. The numbers I'm looking at don't show a growth story. They show a business in structural failure. While the rest of the sector is sitting at all-time highs, this stock just hit a new 52-week low of around $7.75, losing 24% of its value in a single day following its Q3 release. Today, I'm going to walk you through why I believe C3 AI is the first major victim of the AI bubble, and why the destination for this stock is far more likely zero than a lot of holders want to imagine. Before we get into the details, if you happen to have a stock that you would like me to take a look at, please do me a favor, put it in the comments. I am always on the lookout for some good ideas to look into. Now, let's set the stage. It's February 2026. This isn't 2023 anymore, where AI was a buzzword. Today, it is a reality. Companies are spending billions to integrate large language models and predictive analytics into their workflows. If you have a working product in this space, you should be drowning in orders. But when I look at C3 AI, the fundamentals tell a different story. I've broken this down into my three core pillars: profitability, growth, and safety. While looking at the numbers, I found a bloodbath. In the enterprise software world, we expect high margins. Once the code is written, selling it to the next customer should be almost entirely pure profit. Instead, C3 AI is operating with a net margin of negative 108%. I'm going to say that again, negative 108%. Think about what that actually means. For every dollar that they bring in from a customer, they are spending over $2 just to keep the lights on. On a trailing 12-month basis, they have posted a GAAP net loss of over $381 million. This isn't an early-stage startup loss. This is a public company with a multi-billion-dollar valuation that has been public for years and still has no visible path to a single dollar of profit. They aren't building a business. They're subsidizing their existence with shareholder capital. Your capital. This is where the thesis truly dies. In a secular bull market, growth is your oxygen. If you aren't growing, you are dying. In all honesty, I could end this video right here. If what I've just said doesn't tell you everything you need to know about this stock, then it's pretty obvious that I'm not likely going to be able to help you anyway. But in the interest of being thorough, let's look at some details. For Q3 2026, the company just reported revenue of $53 million. That is a massive 30% miss against Wall Street's $75 million expected consensus. Worse, revenue was down 46% year over year. In the most explosive growth environment for technology in human history, C3 AI is actually shrinking by nearly half. When a tech company loses nearly a quarter of its revenue, while its competitors are seeing 40 to 50% gains, it tells you the market has already voted. But here's the part that management can't spin. Alongside these dismal numbers, C3 AI announced a massive 26% reduction in its global workforce. They're cutting hundreds of employees, including 18 data scientists and 45 engineers, to save $135 million in cost. You don't fire a quarter of your specialized talent if your product is winning. You do it because you're in survival mode. The customers are leaving. The product is not winning. This isn't a cyclical pullback. It is an absolute rejection. The bulls will point out the balance sheet. And yes, it looks clean at first glance. They have right around $700 million in cash and zero debt. On paper, that is a safety net. In reality, it's a melting ice cube. They had a negative free cash flow of approximately $47 million last quarter. If they continue to lose $200 million a year just to stay operational, that cash pile isn't a war chest, it's a countdown clock. I do want to take a second here to talk about something slightly more important than a single ticker, though. I want to talk about the ticker trap. C3AI pulled off the greatest branding heist in the history of the New York Stock Exchange. They secured the ticker symbol AI. It is the ultimate search engine optimized stock. Thousands of retail investors bought this stock over the last 3 years simply because they wanted exposure to AI. And this was the most obvious way to get it. But here's the lesson. The ticker symbol is not the business. In 1999, companies were adding .com to their names just to get a 50% bump in their stock price. Most of those companies are gone now. Why? Because the name doesn't generate free cash flow. A name doesn't build a moat. Our job as disciplined investors is to ignore the branding and audit the actual business. If the numbers tell you that the business is failing, don't let a clever ticker symbol trick you into holding a bag for the next 5 years. Discipline is the ability to see the hype and choose the data instead. To understand why C3AI is failing, you have to look at who they compete against as well. While they were busy rebranding and changing their pricing model for the 4th time, Palantir was in the trenches. Palantir's artificial intelligence platform is actually being deployed at scale. They are showing triple-digit growth in their US commercial sector. They are GAAP profitable. They aren't just selling tools, they are selling a central operating system for the modern enterprise. The market has realized that if you want big data AI, you go to Palantir. You don't go to the company that is shrinking by 46%. Then you have the toll booths. Intuit just reported Q2 results showing they are successfully monetizing AI, even partnering with Anthropic to bring custom AI agents to the mid-market. For a mid-sized company looking to use AI, it is infinitely easier just to flip a switch in their existing Intuit or Microsoft contract than it is to sign a new, complex deal with a struggling third party like C3AI. They are stuck in the no man's land of tech too small to compete on scale and too slow to compete on innovation. Now, let's get into the thesis killer. Why do I believe this isn't just a bad year, but a terminal decline? First, the pricing model. C3AI famously switched from a subscription model to a consumption-based model. Management told us this would accelerate adoption. The reality? It's led to massive revenue quality concerns. And lumpy, unpredictable income. Customers aren't consuming more. They're using the transition as an excuse to leave. Second, we have the sales execution failure. You don't fire your sales leadership and restructure the entire team in the middle of a bull market unless something is fundamentally broken. They recently admitted to poor execution that led to their massive misses. In enterprise software, once you lose the confidence of the sales floor, you've lost the company. Third, we have the pure play fallacy. Management claims to be the only enterprise AI application provider. That's a fantasy. They are being attacked from all angles by AI native startups that are more agile and don't have the baggage of a legacy business model. Finally, we have the guidance withdrawal, perhaps the most damning evidence. The company has been facing strategic uncertainty. When the management team stops telling you where they think the business is going, it's usually because they don't like the answer. So what is the bottom? Right now, the stock is struggling to hold $8. Analysts at KeyBank and Wolfe Research have officially capitulated, slashing their targets down to $6. My 2026 price target? I think $6 is probably the first level of support. But frankly, with a GAAP net loss of $133 million this quarter alone, I believe it could go lower. If the revenue contraction continues, the market will eventually value this company at its liquidation value. Not to mention that as the cash reserves get lower, there is a real possibility that they will issue new shares in order to raise cash, diluting the current share pool and making every existing share worth less by default. My 5-year forecast, I expect the S&P 500 to continue its journey of compounding wealth. I believe C3 AI is a high probability candidate for a permanent loss of capital. In 5 years, I do not see this as an independent company. I see it as either a distressed asset being sold off for its parts, or, more likely, a footnote in the history of the 2020s AI bubble. For me, I am way out of this one. There is no value in a business that is shrinking in a growth market. There is no safety in a pile of cash that is being lit on fire. Investing isn't about being right on every stock. It's about being disciplined enough to avoid the ones that will destroy your portfolio. C3 AI has the right name, but they have the wrong numbers. I'm aware that I could be very wrong here. In 5 years, maybe I'm issuing an apology video. Truth is that no one can predict the future. If I could, I wouldn't be making this video right now. Remember that this is not financial advice. I am simply telling you my thoughts on this business, and it is simply not right for me and my portfolio. I'm going to stick to the audit, trust the data, and not let a ticker symbol be the reason I lose my shirt. If you want to check out a different audit, check out one of these videos above me. And as always, I'll catch you in the next one.